Welcome to Learn Wealthy, your go-to channel for real estate insights, market charts, and golden opportunity. Let's build wealth.
Good morning, market watchers. It's Monday morning, and just like your coffee, the market is hot. Or not. Stocks are doing their usual roller coaster dance, and real estate's playing hard to get. And bonds, we're going to look at the 10 and 2-year Treasury spread. Oh, and the Dollar General, they've dropped harder than your 2024 New Year's resolution. Buckle up, because this week's market ride is just getting started. My name is James Santiago, and you're watching your show, Learn Wealthy. Let's break it down. So the stock market had a mixed start to the week. The Dow Jones Industrial Average continues its upward trend since that SOMS rule was triggered on the first week of August. The S&P 500 remained relatively flat, hovering near a key resistance level, as tech stocks helped offset losses in other sectors. The Nasdaq Composite gained 1.13%, supported by a rally in semiconductor stocks. Investors are looking ahead to the latest economic data, including the upcoming Consumer Price Index report, or the CPI, the upcoming BLS job report on Friday, September 6th, where if the unemployment goes up further, it will support the SAMS rule and the yield curve bull steepener, saying that we are headed for a recession. If the SAMS rule gets untriggered from a lower unemployment report, then we'll have to rethink our base case. All these upcoming reports could influence the Federal Reserve's next move in rate cuts. And we'll keep you posted in this channel, Learn Wealthy. In the real estate, the housing market showing signs of cooling as we enter the fall season. Nationally, the number of new listings has increased slightly, but buyer demand remains subdued due to high mortgage rates. This is causing a further slowdown in home price appreciation. Major markets like San Francisco and New York are even experiencing a higher than average number of price reductions, indicating a shift towards a buyer's market. Meanwhile, the commercial real estate sector is still grappling with high vacancy rates in office spaces, particularly in urban centers. Here in the Treasury market, as you can see, Treasury bonds. As you can see, on August, this is the Fed chart, Federal Reserve chart, on August 30. Actually, it uninverted somewhere around August 28. Let's zoom in. There, it uninverted a little bit. August 28, it uninverted by 0.01. And now it's on August 30 was flat. But now I think it's inverted again by 0.1. 2-year, 10-year Treasury, 3.919, 3.909. It's inverted by 0.01. This is the behavior of the yield curve. It uninverts, and then that's not it. It goes back to being inverted. It uninverts, goes back to being inverted. It uninverts, go back to being inverted. And then it fully uninverts and continues to go up in bull steepener fashion. Right? This part. In a few months from here, around May to December, in a few months, you'll hit your recession, your gray bar right here. And it's mostly like that throughout history. You got this inversion. That's not it. Inversion. And then uninversion, real uninversion. And few months, recession. Same thing here. Same thing in history. We are doing that right now. The uninversion is gonna uninvert a little, and it goes back to being inverted. And then we're just waiting to see that full uninversion in a bull steepener fashion. And then in a few months, we're going to expect a recession. If you like getting updated on the market, whether it's real estate, treasury, stock market, economic news, Learn Wealthy is your go-to channel. Please subscribe and hit the bell notification so you never miss a thing. On the economic front, all eyes are on the upcoming inflation report, which will provide fresh insights into the state of consumer prices. The Fed's Beige Book, due later this week, will also offer a snapshot of economic conditions across various regions. And we're going to update you with that here at Learn Wealthy. In international news, China's economy continues to struggle with weaker than expected data, raising concerns about global growth. Additionally, the G20 summit wrapped up over the weekend with leaders agreeing on a series of measures aimed at boosting global trade and addressing climate change. The Dollar General stocks experienced a sharp drop, falling nearly 30% on Thursday, marking the largest single-day decline in the company's history. This drop occurred after the company reported disappointing second quarter earnings and significantly lowered its full-year outlook. The earnings miss was attributed to weaker than expected consumer spending, particularly among its core financial constrained customers. As a result, Dollar General's shares have now fallen over 35% year to date. Dollar General is supposed to be the place where poor and middle class can buy stuff when they can't afford it from other places that are more expensive. Now, they can't even afford Dollar General. And a lot of the mainstream news will tell you, we're headed for a soft landing. There's going to be no recession. Forget the yield curve. Forget the SOMS rule. What do you think as an American consumer? I want to know what you think. Please comment if the economy is getting worse or it's booming. Please like this video if you picked up something, and it will really help me keep making more of these market updates. Don't forget to subscribe, and I'll see you in the next video.